Dear viewers, I'm your host Muhammad Asif Jaja and you are watching YouTube channel ETV 786. This channel is for everyone, education for business students and entertainment for general public. Welcome to your own channel. Please watch, like, share and comment the videos and subscribe the channel to view upcoming shows. On this channel, we have completed the basic concepts of accounting. 23 complete lessons may be watched on the channel. Now starting the second study course, Business Law. This is lecture number 3, Introduction to Business Law. The topics will be covered in this session shall be as follows. Number 1, Title and Risk of Loss. Number 2, Performance and Remedies. Number 3, Product Liability. Number 4, Bailment. Number 5, Storage. Number 6, Mandatory items for warehouse receipt. Number 7, shipping of goods. Number 8, leasing of goods. Number 9, commercial paper. Number 10, negotiation of commercial paper. Number 11, holder in due course and defenses. Number 12, liability and discharge. Number 13, legal aspects of banking. Number 14, consumer credit transaction. And number 15, secured transaction and suretyship. Title and risk of loss. Title refers to ownership of a good. Whichever party legally owns the goods at a moment is the one with title. Risk of loss refers to which party bears the risk for damage or destruction of the goods. Notwithstanding the form of shipment, title or other property interest, risk of loss shall not pass from the contractor to the authorized user until the products have been received, inspected and accepted by the receiving entity. Acceptance shall occur within the reasonable time or in accordance with the such other defined acceptance period as may be specified in the bid specifications or purchase order. Any delivery of product that is substandard or does not comply with the bid specification or contract terms and conditions may be rejected or accepted on an adjusted price basis as determined by the Commissioner. Performance and remedies. The parties often set out in their contracts the details of performance. These include price terms, terms of delivery, where, when and how the goods are to be delivered. If the parties fail to list these terms, the Uniform Commercial Code rules will determine the parties' obligation. In any event, the parties have an obligation to act in good faith. There are special remedies for those damaged or injured by defective products. The contract may be either a shipment contract, a destination contract, or a contract where the goods are not to be moved, being held by a bailee. In any case, unless otherwise agreed, the delivery must be at a reasonable time and the tender. The offer to make delivery must be kept open for a reasonable time. The buyer must furnish facilities reasonably suited to the receipt of the goods. Product liability. Defective or dangerous products are the cause of thousands of injuries every year around the globe. Product liability law is the set of legal rules concerning who is responsible for defective or dangerous products, but they are different from ordinary injury law. This set of rules sometimes makes it easier for an injured person to recover damages. Product liability refers to a manufacturer or seller being held liable for placing a defective product into the hands of a consumer. Responsibility for a product defect that causes injury lies with all sellers of the product who are in the distribution chain. In general terms, the law requires that a product meet the ordinary expectations of the consumer. When a product has an unexpected defect or danger, the product cannot be said to meet its ordinary expectations of the consumer. Bailment. Bailment is the rightful possession of goods by one who is not the owner. It is the element of lawful possession, however created, and the duty to account for the things as the property of another that creates the bailment, regardless of whether such possession is based upon contract in the ordinary sense or not. The law of bailment is important to virtually everyone in modern society. Anyone who has ever delivered a card to a parking lot attendant, checked a coat in a restaurant, deposited property in a safe deposit box, rented tools, or taken items, clothes, or appliances into a shop for repair. In commercial transactions, bailment law governs the responsibility of warehouses and the carriers, such as UPS and FedEx, that are critical links in the movement of goods from manufacturer to the consumer.
storage. Warehousing has been called the second oldest profession, stemming from the biblical story of Joseph, who stored grain during the 7 good years against the famine of the 7 bad years. Whatever its origins, warehousing is today a big business, taking in billions of dollars to stockpile foods and other goods. A warehouser is defined as a person engaged in the business of storing goods for hire, and a warehouse receipt is any receipt issued by a warehouser. The warehouse receipt is an important document because it can be used to transfer title to goods, even while they remain in storage. It is worth money. No form is prescribed for the warehouse receipt, but unless it lists in its terms the following 9 items, the warehouser is liable to anyone who is injured by the omission of any of them. Mandatory items of the warehouse receipt. Number 1, location of the warehouse. Number 2, date of receipt was issued. Number 3, consecutive number of the receipts. Number 4, statement whether the goods will be delivered to bearer, to a specified person, or to a specified person or his order. Number 5, the rate of storage and handling charges. Number 6, description of the goods or the packages containing them. Number 7, signature of the warehouser, which his or her authorized agent may make. Number 8, the warehouser's ownership of the goods, if he or she has a sole or part ownership in them. Number 9, the amount, if known, otherwise the fact, of advances made and liabilities incurred for which the warehouser claims a lien or security interest. Shipping of goods. Number 1, the shipment of goods throughout the globe is a very big business, and many specialized companies have been established to undertake it, including railways, air cargo operations, trucking companies, and ocean carriers. A bill of lading is a document that evidences the receipt of goods for shipment issued by a person engaged in business or transporting or forwarding goods. Number 2, the common carrier contains 3 elements. Number 1, the business is not restricted to particular customers but is open to all who apply for its services. Number 2, it must charge for his services. Number 3, the service in question must be carriage, household moving companies, taxi cabs, towing companies, and even oil and gas pipelines are the examples. Number 3, note that a common carrier may limit the types of goods or the places to which they will transport them. Leasing of goods. Lease good means goods that the contracting authority has chosen to lease from the supplier on a fixed term basis in exchange for regular monthly payments. The ownership of the leased goods shall remain with the supplier throughout the leasing agreement. When you lease goods from a merchant, you don't become the owner. Instead, you become the leasee, and the merchant remains the owner. The merchant can offer to leasee to sign. Number 1, contract of lease with an option to purchase. At the end of the lease, it's possible to buy the leased goods and become the owner for a price set ahead of time in the contract, which is called the buyback price. Commercial paper. Commercial paper is a commonly used type of unsecured short-term debt instrument issued by corporations, typically used for the financing of payroll, account payable, and inventories, and meeting other short-term liabilities. Maturities on most commercial paper ranges from a few weeks to months, with an average of around 30 days. Commercial paper is often issued at a discount without paying coupons and matures to its face value, reflective of current interest rates. Commercial paper is not usually backed by any form of collateral, making it a form of unsecured debt. Commercial paper is only issued by firms with high-quality debt rating. Only these kinds of firms will be able to easily find buyers without having to offer a substantial discount, higher cost, for the debt issue. Negotiation of commercial paper. Negotiation means that an instrument has been transferred, either voluntarily or involuntarily, to the holder by someone other than the issuer. The paper is negotiated upon. Number 1, transfer of possession. The transferee may become a holder upon transfer. A holder must be entitled to enforce the instrument. This excludes individuals who forge a signature on order paper. And number 2, endorsement, signatures by the holder. Endorsement is not generally required for bearer paper, as the holder is not necessarily named on the instrument. The holder of the instrument has the right to force the transferor to endorse the instrument. Holder in due course and defenses. In commercial law, a holder in due course is a person who takes a negotiable instrument in a value-for-value exchange without reason to doubt its legitimacy. A holder in due course acquires the right to make a claim for the instrument's value against its originator and intermediate holders. Even if one of these parties pass the instrument in bad faith or in a fraudulent transactions, a holder in due course may retain the right to enforce it. The holder in due course doctrine is important because it allows the holder of a negotiable instrument to take the paper free from most claims and defenses against it. Without the doctrine, such a holder would be a mere transferee. Liability and discharge. Agents often sign on behalf of principals, and when the authorized agent makes clear that he or she is so signing by naming the principal and signing her name as agent, the principal is liable, not the agent. But when the agent signs incorrectly or fraudulently, the rules says in general that the agent is personally liable to an holder in due course who takes the paper without notice that the agent is not intended to be liable. Unauthorized signatures, forgeries, are ineffective as to the principal. They are effective as the forger's signatures, unless the principal or the person paying on the instrument has been negligent in contributing to or in filing to notice, the forgery in which case comparative negligence principles are applied. Legal aspects of banking. This is about the laws that govern the operations of the banking system with respect to its depositors and customers. Although histories of banking dwell on the relationship between banks and the national government, the banking law that governs the daily operations of checking accounts is state-based nowadays. To trace the traditional check collection process, it is necessary to understand the terminology used. The bank upon which a check is written is the payer bank. The depository bank is the one the payee deposits the checks into. Two terms are used to describe the various banks that may handle the check after it is written: collecting banks and intermediary banks. All banks that handle the check except the payer bank are collecting banks. Intermediary banks are all the collecting banks except the payer and depository banks. A bank can take on more than one role. Any other bank through which the check travels except the two banks already mentioned is an intermediary bank. Consumer credit transaction. Consumer credit transaction are consumer credit sales, consumer lease, or consumer loans, or a modification thereof, including a refinancing, consolidation, or deferral between a merchant and a customer in which real or personal property, services, or money is acquired on credit and the customer's obligation is payable in installments, or for which credit a finance charge is or may be imposed. Whether such transaction is pursuant to an open-end credit plan or is the transaction involving other than open-end credit. Lenders, whether banks or retailers, are not free to charge whatever they wish for credit. Usury laws establish a maximum rate of lawful interest. The penalties for violating usury laws vary from state to state. The heaviest penalties are loss of both principal and interest, or loss of a multiple of the interest the creditor charged. The courts often interpret these laws stringently, so that even if the impetus for a usurious loan comes from the borrower, the contract can be avoided. Secured transactions and suretyship. Debtor borrows money or obtains credit from creditors, signs a note and security agreement putting up collateral, and promises to pay the debt, or upon debtor's default, let creditor's secured party take possession of the collateral and sell it. The grasping hand is creditor's reach for the collateral, but the hand will not close around the collateral and take it unless debtor defaults. The secured transaction always involves a debtor, a secured party, a security agreement, a security interest, and collateral. All actual and potential creditors of the debtor are always on notice that the bank with which the debtor's deposit account is maintained may assert a claim against the deposit account. Perfection can also be achieved by a pledge, that is, possession by the secured creditor, or by control of certain assets, that is, having such control over them as to be able to sell them if the debtor defaults.
You are watching YouTube channel ETV 786. This channel is for everyone. Respected viewers, you can also watch basic concepts of accounting through above given 3 playlists and homemaking ideas and many more through multiple playlists public magazine, and subscribe the channel for upcoming shows. Bye bye till the next show.